Continuing with topic 4 of paper 12 under section 4.3 active asset allocation, we're now going to continue by looking at the use of derivatives in active asset allocation, and that's paragraph 4.3.2 on page 4.8. Now, do we use derivatives in active asset allocation? Yes, it can be done, but there is a bit of regulation around them from the Code on Unit Trusts and Mutual Funds that we will look at very shortly. The notes tell us purchase of underlying assets incurs trading costs, can be relatively illiquid. So when you're actually buying the underlying assets, possibly securities, there may not always be an active market. Markets for derivatives are much more liquid. Derivatives private are cheaper and quicker alternative in many situations. And as I was saying, the regulation in Hong Kong, we've got the Code on Unit Trusts and Mutual Funds, and that restricts how derivatives may be used by fund managers, especially those of collective investment schemes, unit trusts and mutual funds. Now, disadvantages of using derivatives as an asset allocation tool include, well, whenever you see disadvantages or indeed advantages, you can think choices in a question. So disadvantages include difficulty of achieving an optimal spread of derivatives. Additional risk of holding derivatives must be acceptable given a fund's risk profile, because we pay premiums for derivatives options, for example. And if things go against us, we can lose the premium. We don't actually benefit. Exchange-traded derivatives may not be accessible, requiring the use of over-the-counter derivatives, and that increases your risk. Now, for unit trusts and mutual funds, usually regulatory and or self-imposed restrictions on the use of derivatives, and the regulatory ones, as we've looked at, Code Unit Trust Mutual Funds. So be aware of that, easily examined. Synthetic exchange-traded funds make use of derivative products so as to replicate performance of underlying indices. Now, that's a lot more complex, and you have to have the required expertise. Many hedge funds make extensive use of derivatives to implement investment strategies. So, looking at the bigger picture, derivative products can be used with respect to following trading or investment strategies. So we're going to consider investment or speculation using derivatives, hedging and risk management using derivatives, and we'll look at shortly the use of derivatives for arbitrage, making a risk-free profit. So what are the points we've got to consider when looking at investment or speculation when using derivatives? Well, a fund manager may use derivatives to make risk-adjusted returns subject to a high leverage effect. That is, that you can, for the amount of investment, make a relatively high return, but conversely, a relatively high loss. Two views that can be taken regarding future price movements of an underlying asset. One relates in the direction, up or down, and the other to the volatility of price movements. Now, if an asset manager believes an underlying asset price may rise, he can buy futures-based contract, price goes up and then closes out by selling, or call option-based contract. So that's a call option, which gives you the right to buy the underlying asset at the exercise price. If an asset manager believes an underlying asset price may fall, she can sell a futures-based contract or buy a put option-based contract. So be aware of those strategies. Very simple, easily examinable. An asset manager who expects high volatility in an underlying asset price can buy a call option and a put option on the underlying asset with the same exercise price and the same maturity, and that's known as buying a straddle. This is more paper 9 material, but it is methods of using derivatives, specifically options, for speculation. If the future or forward price of an underlying asset is higher than the spot price, asset manager can buy short-dated futures contracts on the underlying asset, sell long-dated futures contracts if he expects the spread between the two prices to narrow. And that's known as buying the spread. So these are particular derivative strategies. And the last point, if the price of a portfolio of an underlying asset expected to remain within a particular range, fund manager may sell call options. So you're making money from selling the options, receiving the premium of the underlying assets, thereby enhancing portfolio income. And that's known as covered call strategy. As I say, paper 9 gets into this in a lot more detail. That is a paper on derivatives. I'd generally be aware of the use of derivatives in some of these strategies for investment or speculation. The second strategy is hedging and risk management. Now, hedging is used by a portfolio manager who's exposed to downward price risk, unable to liquidate the investment. So he has to hold, or she has to hold, the securities, but they may go down in price. So you can use derivatives to make a profit when the assets fall in price. To reduce or even eliminate the risk, manager can take the opposite position in futures contracts on the portfolio. So if you're holding investments, you sell futures, and if they go down in price, close out your position by buying, thereby making a profit, which will eliminate, hopefully, the loss you've made on the underlying investments. An asset manager who wants to protect the investment portfolio by restricting maximum possible loss to a specified level may buy stock market index put option, and that's referred to as portfolio insurance, and that maintains the upside potential if portfolio value suddenly increases. To reduce or eliminate currency risk, portfolio manager may enter into currency forward contracts. So you're buying a currency forward at an agreed price, sell the currency of the underlying assets and buy currency of the managed fund. And the third strategy with regard to derivatives that we're considering is arbitrage. Now, pricing relationship between a derivative and the underlying asset breaks down, arbitrage opportunity will arise. It's a risk-free way of making a profit. Factors that may compromise the use of this strategy, and this is just a little bit further down, transaction costs. So yes, there may be a guaranteed profit, but will it be eliminated through transaction costs? Mark-to-market loss, as the arbitrage profit takes a long time to materialize, needs to be considered. Regulatory and market restrictions on trading. Market liquidity can be a problem. Actions of uninformed traders may take the potential profit away from you. And then we're told, Securities and Futures Amendment Ordinance 2014 expanded the scope of Type 9 asset management license to include management of portfolios of over-the-counter derivative products, OTC derivatives. Now, this is brought in two more regulated activities, number 11 and 12, but they're taking some time to actually be activated. Okay, so 3 trading or investment strategies with regard to derivatives, investment speculation, hedging and risk management, arbitrage. Be aware of them, some of the detail, do the practice questions, but it's unlikely at paper 12 they will go into as much detail as has been listed there. Now, continuing with the active management, looking at the active return. So the return of management fund made up of 2 components: the strategic return, that is the allocation to the bonds, the equities, the cash, etc., and active return. Now, the active return is only relevant when you're considering managers that are practicing active asset allocation. Now, please be aware, the active return made up of 3 components, and this sometimes a little bit confusing because people believe this is tactical asset allocation. Well, tactical asset allocation is part of the active return. Also incorporated in the active return, security selection and interaction between security selection and tactical asset allocation. Now, when we look at attribution analysis at the end of this topic, we will come back and consider some of the active return components. Now, taking the first item under active return, tactical asset allocation. Now, active strategies to enhance performance by shifting asset mix of a portfolio as opportunities arise. Well, what you're doing is you're flipping, you're moving, you're selling one security, buying another, as you consider short-term opportunities. Now, tactical asset allocation can be categorized as discretionary or qualitative and quantitative. Now, discretionary approach normally relate to global themes such as macroeconomic or political events. So discretionary is where you see the change in a prime minister or a president as indicating a move in macroeconomic policy, and you may move short-term investments accordingly. Quantitative approach uses economic metric and statistical models. Continuing, tactical asset allocation can be introduced in one of three ways: an overlay, an actual fund, or using an asset consultant. I would say just getting into a bit too much detail, but nevertheless, be aware of those three approaches to tactical asset allocation.